Howdy, y'all. Welcome to Liberty Call. I am Raymond Dahlman, your humble host here, and it is Monday, July 24th, 2023. Hope everybody's having a fantastical day out there and a good weekend. Looks like the markets are off to somewhat of a decent start. Most people are probably on pins and needles with the Fed meeting tomorrow and Wednesday. And from most of what I've read, most people seem to be, kind of geared in that rates are going to go up by another 0.25%. And then we're going to have another 2 months of, are they going to raise rates in September? Are they not? Oh my gosh. Anyways. All right. Well, like I said, I'm glad you're here. Thank you very much for being here and watching Liberty Call. If you could do me a favor, give me some thumbs up, likes, shares, subscribes, follows, notifications, so that when I go live, you get a little ding. That'd be nice. All right. Well, let's go ahead and jump into the numbers for today. Dow Jones was up 0.52%, 183 points, closed at 35,411. SP 500 was up 0.4%, closed at 45,54. NASDAQ up 0.19%, closed at 14,058. The VIX was up again today, 2.28%. It's currently at 1391. Canada was up 0.17, Brazil was up 0.94, and Mexico was down 0.3%. Over in Europe, Germany was up 0.08, UK up 0.19, France down 0.07, Netherlands down 0.28, Spain down 0.29, Italy up 0.18, Switzerland down 0.27, and Portugal up 0.17. Russian exchanges both in the green, MOEX up 0.48, RTSI up 1.08%. And the overnights, the Nikkei in Japan was up 1.17%. Australia was down 0.1%. New Zealand was up 0.37%. In China, the Shanghai was down 0.11%. The Shenzhen component down 0.58%. China A50 down 0.54%. DJ Shanghai down 0.17%. And the Hang Seng down 2.25%. Taiwan weighted came in flat at up 0.02% for the day. So like I said, most, or I guess here, people think things are doing okay. I don't kind of feel the same way, but, we'll see where things are going. All right, let's see what the weekly economic update had to say. Stocks moved to the rhythm of earnings season last week, initially rising on positive earnings surprises and faltering later in the week on key earnings disappointments. The Dow Jones was up 2.08%. The SP 500 added 0.69%. The NASDAQ was down 0.57%, and internationals fell 0.32% for the week. Earnings in focus. Entering the first big week of the second quarter earnings season, solid reports from the nation's big banks rewarded investor optimism, sparking a rally that continued into midweek. An announcement by a mega cap tech company of a new AI subscription plan and stabilizing deposits at several regional banks further fed investor enthusiasm. Disappointing earnings from two big tech names dragged market indices lower on Thursday, with the largest losses in the NASDAQ composite. Despite the reversal, 20 stocks in the SP 500 touched 52-week highs on Thursday, with 11 reaching all-time highs. Stocks closed flat to end the week and an otherwise mixed week. Housing hits a bump. June housing reports reminded investors that emerging housing recovery remained shaky. After a massive 21.7% jump in housing starts in May, new home construction tumbled 8% in June, with building permits, an indicator of future home construction, dropping 3.7%. Sales of existing homes were also lower in June, declining by 3.3%. Owing to a persistently low inventory level. This was the slowest pace since January. Year-over-year sales were lower by 18.9%. One reason for low inventory is that homeowners have been reluctant to sell homes on which many have historically low mortgage rates and face buying a new home at elevated prices with a much higher mortgage interest rate. That's pretty much it. Delicious. All right, key economic data this week. On Monday, we have the PMI composite flash. Tuesday, we have consumer confidence. Wednesday, the FOMC announcement. That's the Fed rate meeting. And new home sales. Thursday, we have GDP, durable goods orders, jobless claims. And Friday, we have personal income and outlays. All right, so that was the weekly update. So kind of a mixed week last week. There's some good news, some bad news. But again, be careful out there. If you think things are all clear and, you want to push your money back into the market, feel free. That's just not what I'm doing right now. All right, let's go to the market recap. S&P 500 higher ahead of big tech earnings and a Fed decision. Where's my notes? There we are. All right. In Monday's market, the S&P 500 displayed gains, bolstered by a rally in the energy sector as investors continue to digest positive quarterly results from major tech companies and awaited the Federal Reserve's upcoming decision. Leading the day's gainers were energy stocks with Halliburton Company, Occidental Petroleum, and Chevron Corp at the forefront. Chevron stood out with a more than 2% increase following better than expected quarterly results, thanks to record quarterly production in the Permian Basin. UBS's note indicated that operational results were limited but still positive, confirming improved Permian well performance and progress on TCO, which is Tengiz Chivrol projects. It's a tongue twister. Let's see here. The energy sector has also benefited from rising oil prices, which reached April highs due to expectations that OPEC's supply cuts would tighten market conditions. Regional banks experienced a rally, particularly boosted by stabilizing deposit figures from KeyCorp, Huntington Bancshares, and Citizens Financial Group in their recent quarterly reports. PacWest Bancorp, which had faced concerns about smaller bank weakness since the May banking crisis, surged over 8% ahead of its upcoming results. In the tech realm, Alphabet and Microsoft are set to announce their earnings on Tuesday after the market closes. Following a recent slump in Tesla and Netflix last week, bullish bets on tech face challenges. However, Wedbush expressed optimism, identifying positive themes such as cloud strength, AI monetization, digital advertising stabilization, and a less cautious IT spend environment. Wedbush sees a compelling case for owning tech stocks during the second quarter tech earnings season. On Tuesday, the Federal Reserve's two-day meeting commences with a 0.25% rate hike nearly fully priced in, according to Investing.com's Fed Rate Monitor tool. Morgan Stanley predicts that the widely expected rate hike on Wednesday might be the final one, projecting the peak of federal funds rate for the year to be 5.375%. In anticipation of the upcoming rate hike, Treasury yields rose on Thursday, with the two-year Treasury yield, which is sensitive to Fed rate changes, reaching 4.9%. Investors are closely monitoring the Fed's decision and its potential implications on the market. So I guess we just sit and wait and see for the next 2 days and see what the Fed's going to do. I mean, my guess is they're going to raise rates. The market's going to kind of flounder for the next, I don't know how long, until people come to the realization that things aren't getting any better. But, kind of reminds me of 2007. We'd had an inverted yield curve since 2006. Going into 2007, everyone thought things were still going to be good, or actually during all of 2007. And then, by the time we get to 2008, the yield curve's gone back to normal. But, we know what happened in 8 and 9. So, all right, last article up comes from our friends at First Trust, Mr. Brian Westbury, their chief economist. It's titled Still Growing. All right, there we go. All right, the GDP report for the U.S. in the second quarter shows that the economy is not in negative territory, which is good news. However, the estimated growth rate of 2.1% is far from the robust growth we've seen during the economic expansions of the 80s and 90s. To foster long-term economic growth, the country needs policies that promote more capital formation, improved education, and easier ways to support future generations. Despite the current growth rate, there are concerns about the U.S. heading towards a recession. Some argue that the strong job market will prevent a recession, but history shows that the job market is often at its peak or near peak levels when the economic downturn begins. While it may not be as severe as past crises like the COVID lockdown or the 2008-09 financial panic, even a mild recession can bring economic pain. During the second quarter, the economy grew at a moderate rate, estimated at 2.1 annual rate. Real retail sales outside of the auto sector declined at 3.3% annual rate, but sales of autos and light trucks increased at a 9.5% rate. And services, which from a significant part of the consumer spending, are expected to be up around 2.5%. Overall, real consumer spending on goods and services combined at a tepid 1.2% rate, contributing 0.8 points to real GDP growth rate. Business investment is estimated to have grown at a rate of 7.5%, with gains in intellectual property and commercial construction leading the way. This growth rate would add 1 point to real GDP growth. Despite some challenges from higher mortgage rates, residential construction showed resilience, with an estimated decline rate of 2.6%, subtracting 0.1% from real GDP. Regarding government, only direct purchases of goods and services count towards GDP calculation, not transfer payments. It is estimated that these purchases, representing an 18% share of GDP, increased at a 2.3% rate in Q2, adding 0.4 points to the GDP growth rate. The trade deficit expanded during the quarter, which net exports projected to subtract 0.9 points from real GDP growth. Now, for those who were in my meetings mid-year already, we talked about that, how the trade deficit's begun to widen again, and how that's going to have a negative effect on GDP throughout the rest of the year. On the positive side, inventories grew faster in Q2 compared to Q1, suggesting that they will add about 0.9 points to the growth rate for real GDP. However, during a recession, inventory declines are expected to play a significant role in the GDP drop. Summing up all the factors, with the estimated annual real GDP growth rate for the second quarter is 2.1%. While this growth rate is not negative, it falls short of the robust expansion seen in previous decades. Policymakers need to focus on measures that will support long-term growth and strengthen the economy to face any potential challenges ahead. All right. So all we need to do is have a government that is fiscally responsible, prepares for challenges in the future, and stays out of the economy's way. Basically do the opposite of what they do right now. Agreed? That's what I thought. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.